Hello and welcome to Moneylife News and Views. I am Debashis Basu. Those who are in their late 60s now or older would know that one of the chief features of the 70s or mid 70s has now come back to us. No, I'm not talking of the return of disco dancing or of bell-bottom trousers, but inflation. As single-digit inflation persists in the West and has hit double digits elsewhere, it suddenly seems as though the nations have lost control over price rise, which is really the ultimate nightmare of politicians, policymakers, and investors everywhere. Central banks, as a result, having seen visions of what happened in the 70s, are now rushing to tighten money supply, which is reducing liquidity and increasing interest rates to control inflation. And governments are simultaneously trying for curbs on imports, exports, and taxes to control prices. They are facing two problems in doing this. One, after many years, the world is simultaneously under a demand and a supply shock, with no immediate solution to either. And two, for the first time, inflationary expectations seems to be rising. And this is what the policymakers dread the most. Inflation is as much a matter of perception as of facts. If businessmen and householders feel that the prices are going to rise further, which economists call inflationary expectations, then their actions themselves will push up prices even more, no matter what the government does. In mid-March, I had asked in one of my articles, is the stock market ignoring the coming inflation shock? Since then, the market went up a bit, then fell a lot, and then went up again. Overall, it has remained exactly where it was in about mid-March. Key indices are vacillating, and this means that they are unable to find an answer to one crucial question, which is, can the central banks control inflation quickly by increasing interest rates and tightening liquidity? If yes, the market will go up. If not, the market will continue to go down. One reason why we don't have an answer to this question is that monetary tightening is the only tool that can be deployed easily in the short term, but it is a blunt tool to control inflation. After all, to bring down prices, one has to increase supply, which seems impossible in the short term. So policymakers have to dampen demand to cut inflation. It is possible to cool demand, or so the central banks think, with tighter money supply. Unfortunately, monetary tightening cannot cut down demands for essential products that are non-discretionary, which is like fuels, fertilizers, edible oil, and foods, which is the main cause for inflation now. Tightening can only affect speculative investments, discretionary spending of the middle class, and some asset purchases. This is why among the first casualties of the tightening have been highly speculative investments like crypto-currencies and loss-making technology companies, which are in need of a perpetual supply of cheap capital. If tightening affects discretionary spending, then how will demand for essential items shrink? In the US, these recorded the highest increases last year. Natural gas, 176%, heating oil, 100%, gasoline, 91%, crude oil, 70%, cotton, 66%, nickel, 55%, wheat, 54%, and coffee, 48%. Prices of these commodities will cool only when the supply increases, which is not in the hands of the central banks. By increasing the cost of money, the demand for these products are going to be only marginally affected. However, if inflation does not drop, the central bank will keep tightening liquidity as long as that is the main tool available and deployed. This will destroy demand across the board, just like antibiotics kill both good and bad bacteria. The danger is that these decisions have to be made on the fly with hindsight knowledge, and so the tightening can also go too far, especially if the economy is otherwise strong as it is now. Indeed, in the US, the labor market is tight, and dislocation in supply and demand of a whole range of products from energy to food to industrial raw materials is so severe that it may require extraordinary tightening to bring down inflation, which would also shrink the economy. Such action could even take US to the edge of a recession, As top US investor Bill Ackman says, there is no economic precedent for 200 to 300 basis points of Fed funds, which is what the increased Fed is talking about, addressing an 8% inflation with unemployment at 3.6% only. Current Fed policy and guidance are setting us up for double-digit sustained inflation. It ends when Fed puts a line on the sand, says Bill Ackman, and says it will do whatever it takes to control inflation. And then it demonstrates this seriously by immediately raising rates to neutral and committing to continue to raise rates until the inflation genie is back into the bottle. All this is terrible news because these are drastic actions to control inflation, and it's a really bad news for stocks. As Ackman says, if Fed doesn't do its job, the market will do the Fed's job, and that is what is happening now. Now, as we all know, if the US sneezes, emerging markets in India will catch a cold. But there is a good news. The good news is that market does not react to past data. It is forward-looking. It will not wait for the economic news to improve or for inflation to drop to 2% again. It will watch the intent of the central banks, and if it is not satisfied, keep marking down the prices of stocks selectively. Those with high valuations and low growth will fall sharply. Then, at some point, with the first downtick in inflation, or when the valuation of quality stocks becomes attractive again, the market will rally. After all, valuations of leading Indian stocks are already back to the long-term average, and companies are enjoying strong underlying demand. There is no sign of earnings recession as in the previous periods of high recession, not yet. Also, the excesses of cheap money in India have been confined to the unlisted sector, which indirectly will affect consumption a bit, and only a few outrageously priced initial public offerings. In short, the probability that inflation will come down on its own is low, but this means that if the central banks act harshly now, the market will crash and then rally. If the central banks are hesitant, the pain is going to be prolonged. Thanks for watching, and if you like this, please do subscribe and share.